Welcome to Conversations, Season 2 of the MTA Podcast Series, a weekly audio cast featuring interviews with leading investment strategists, geopolitical experts, and other key thought leaders, brought to you by the Market Technicians Association, and your host, Ed Carlson.
It ain't about how hard you hit, it's about how hard you can get hit and keep moving forward. Tuesday, October 5th, 2010, this is Conversations, the official MTA podcast series, Season 2. And today's guest is Kathy Lien. Kathy Lien is the Director of Currency Research for GFT, Managing Partner of BK Forex Advisor, and the author of the best-selling book, Day Trading and Swing Trading the Currency Markets. As an internationally renowned currency strategist, Kathy specializes in combining fundamental and technical analysis. With more than 10 years of currency trading experience, Kathy is a frequent guest of CNBC Asia and Sky Business News. She is also a regular contributor on Yahoo Finance Australia, The Australian, Wealth Creator, and Money Magazine Australia. Kathy is also frequently quoted in the Sydney Morning Herald, The Age, and the Wall Street Journal. After graduating college at 18, Kathy started her career at J.P. Morgan Chase on their interbank FX trading desk. She's also co-author of Millionaire Traders, How Everyday People Are Beating Wall Street at Its Own Game, and the forthcoming Little Book of Currency Trading, scheduled for release in December 2010. Kathy Lien, welcome to the program.
It's a pleasure to be on, Ed.
Oh, thank you. You know what? We got to go back to that quote right off the bat. It ain't about how hard you hit. It's about how hard you can get hit and keep moving forward. Why don't you tell us where that quote comes from and why you thought it was notable?
Well, that quote comes from Rocky Balboa, of course, from the famous movie. And the reason why I think that this is important for trading, and currency trading in particular, is because a lot of people, when they trade any asset class, they tend to get very aggressive, and they focus a lot on finding the perfect entry, and really relegate their exits to an afterthought. And what this quote is there for is to kind of remind everyone that it's really important to use good risk management, because we all will be hit with a streak of losers one time or another, and if we use too much leverage, which is one of the big things in the foreign exchange market, you can easily wipe out your account. So what I encourage traders to do is to really limit their risk so that even if you get hit, you can keep on moving forward.
Okay. Well, we're going to get a little bit more into entries and exits in a minute, but we always start our podcast with some personal history, and there's one point that really stands out in your bio. You graduated from college at 18. I take it you hadn't discovered boys yet. Tell us about that. How did that happen? And kind of give us a minute or two from, how is it a person graduates from college at 18 up into the point where you discovered technical analysis? Kind of give us some background there, would you?
Well, I basically entered college when most people were basically entering high school. I attended a small college in Virginia called the Mary Baldwin College when I was 13. And from there, I spent a year there. It was kind of a transitional program. I was always really good at math and, good at analysis. So I spent a year at the school and transferred over to New York University, where I decided to study, finance and economics. And actually, my first exposure to technical analysis was through an MTA member and through the MTA, because many years ago, I can't remember how long, more than a decade ago, I had an internship with one of your members, and his name was Dodge Dorland, and I think he's a former president of the MTA. Mm-hmm. And he had actually taken me to one of the MTA conferences down in Texas and invited me to come. So it was there where I kind of, for the very first time met people like Ralph Apkapora, and I learned about technical analysis from the, very beginning of my career. I think I was a sophomore in college. And so, Dodge taught me a lot, and I've always been exposed to charts since then. That was during the technology bubble, so I was using a little technical analysis to trade stocks and got out of it before the bubble burst. And and just kind of went forward from there. I mean, now I use a combination of both fundamental and technical analysis for my FX trading, but my first exposure really to trading in general was to technical analysis.
About that. Okay, now I know somewhere in there you were hired by J.P. Morgan. Why don't you tell us how that fits into all this?
Yes, basically, when I graduated college, I interviewed for a bunch of companies, and J.P. Morgan expressed an interest to hire me for their sales and trading department. So a lot of people ask me, how did you get into currency trading? Well, it was kind of by luck, I would say, because my first rotation at J.P. Morgan was actually on the FX interbank market making desk. And so, we both got along together really well, and everything seemed to make good sense to me. So I joined the FX trading desk and learned how to trade currencies from the inside out. A lot of people out there only see it from the outsider's view and just trade it without fully understanding how the market works on the interbank level. And I think my unique edge is that I've traded currencies on a interbank level as well as traded different asset classes such as equity futures and indices and options, currency options, interest rate derivatives. And so that's kind of where I sort of learned fundamental analysis, because I spent a couple of years on the FX interbank desk, and then I spent a couple of years on the prop trading desk at J.P. Morgan. And there we learned how to use different types of markets to figure out what could be a leading indicator for price action going forward.
Okay. Well, all right. So we got some history. Bring us up to the current date. I know you're an author. I also know you attend some of these. You speak at some of these Money Expo type conventions. Give us an idea as to what you do on a day-to-day basis.
Well, right now I work for a company called GFT, Global Forex Trading, and I'm the Director of Currency Research here. So my responsibility is to write about the markets, what's happening, what are the big stories, where I see the opportunities, whether the dollar is going to continue to fall. I also do a lot of education in different pockets of the world, such as the U.S. and Asia. Like you said, I attend a lot of these different trade conferences to teach people how to trade. I also do a lot of TV appearances and write for magazines. So that's basically what I do on a broad scale. Then on a day-to-day basis, I also trade. I think I'm one of the few analysts out there that consider themselves a trader first and an analyst second, which is why I feel like I have a very good touch into how the market works because I'm in it every single day. I make money, I lose money like every other retail trader. So that's kind of how I spend my day, which is in the morning, when the markets are most active, which is between 8 a.m. to 12 p.m. New York time. I'm trading different pieces of economic data. I'm looking at different setups on a technical level. And then when my day frees up, then I start my writing.
Okay. All right. You mentioned, I mentioned it first, I guess, trade conferences and the retail trader, and that goes right to something I wanted to discuss. For a long time, the foreign exchange markets were closed to individual investors and traders, and it's only been, in the last 10 years that they've gotten access to these markets. Now, here's the first thing I thought of when I was reading this information in your background information. A lot of us think that with the death of the buy and hold cycle in the stock market, that the stock market's really no place for widows and orphans these days, so to speak. So that begs the question, is this newfound access to the FX markets necessarily a good thing for individuals?
Well, I think that the one thing that we should have learned from the global financial crisis is the need for diversification. And so I think that currencies offer that diversification because currencies can move up and down. There's no uptick rule. So when there's a movement in the financial markets where we basically have an all-out collapse, you may actually have some currencies rising. So I think that it's just interesting for a lot of traders to look into because it provides an alternative asset asset class. And at the same time, the world has become very global. And even though I would assume that most of these listeners are Americans, that what happens in the rest of the world still affects what happens in America. So because of that, someone may have a view on what's going on in Europe and whether the euro can continue to rise, or they may travel to Japan a lot and have a view on the economy on that front. And currency is a way to express that view. So I think that it's in this day and age, it's important to look beyond equities. I don't think that currencies will replace stocks as an asset class, but I think it's a nice little diversification tool to look into.
Mm-hmm. Excuse me. We're going to continue with Kathy Lien in a moment, but first a reminder that on next week's program, we'll have Art Huprich, technical analyst at Raymond James. All right. Speaking of Japan, Kathy, the Bank of Japan recently intervened in the currency markets to drive down the value of the yen. It's often said that this is an impossible task for central banks. Is that true? And if so, why do central bankers persist in trying?
Central bankers are mandated to basically maintain stability in their economy and basically promote as much growth as possible without promoting excessive inflation. So at this point, what we're having is that Japan is really crippled by a strong yen. And, if the Bank of Japan doesn't come into the markets and stop it from rising, it will just continue to go up and up and up because partly because Japan has a big trade surplus, and partly because, no one wants to own dollars. So, it's kind of like someone needs to step in and do an intervention. And I think that's really why central bankers will still come into the markets to add some, two-way action and to have traders realize that's not just a one-way trade, even though in the long term it's rarely effective.
Right. I'm looking at the yen right now, and what was it, September 15th, when the Bank of Japan intervened and drove the yen down, and of course it spent all that time coming right back to where it was when they jumped in and spent God knows how much blood and treasure to drive that thing down. So it's back where they started. The news last night was they've dropped their interest rate to zero, and the yen is still up today. Do they? Is it political? Is it just to send a message? And how much money are they willing to spend to do something like this?
Returning interest rates to virtually zero by the Bank of Japan really was just a symbolic move, because the interest rate prior to that was 0.1%. To reduce it to a range of 0 to 0.1% is really a small incremental change and has no significance. But I think what it does is it indicates how frustrated they are with the lack of growth in the economy and the headwinds that lie ahead. And what they did was they reduced the interest rate as well as announced another major asset purchase program. So it was like a 1-2 punch they wanted to dole out. But unfortunately, that was not what the market was looking for. I mean, I think what the market wanted to see was that they would do these two things and then intervene, or at least intervene and then introduce an asset purchase program. But they fell short of that, and I think that really indicates that they don't necessarily have the support within the Japanese government to do all that it takes to stimulate the economy, and investors realize that. So they're continuing to test the limits of the Japanese government by pushing the yen even higher against the dollar, because they're just not satisfied with what they've seen so far.
That's great insight. All right. Let's move on. You have given investors tips to improve their forex trading, and a couple of these tips I want to get into. For example, tip number 1 is buy high and sell higher. And tip number 2, entries and exits are equally important. And you write, unfortunately, most new and even seasoned traders spend hours looking for trading strategies that give them the best possible entries. Exits, however, are usually relegated to nothing more than an afterthought. Okay, I recognize that, and I think most of our listeners would as well, and have learned that lesson. So how does Kathy Lien decide where to sell?
Well, when I trade, I always have fixed entry and exit rules that I try to adhere to. And I think that this touches on the first point that you talked about, which is one of my tips for currency traders is to buy high and sell higher, because in the currency market, trends are very, very strong. And you have to recognize why this is the case, because currencies represent confidence indicators for the country. So usually the economic outlook for a country gets progressively better, or it gets progressively worse. Not often do you see it get better, worse, better, worse, better, worse. So as a result, that is why sometimes the move in currencies can last for days, weeks, months, and sometimes even years. So I always find that it saves a lot of gray hairs to look for opportunities to join the move rather than fade it. I mean, just look at the move in the euro so far. I mean, the euro basically rose from 127 to 138 in approximately a month. And I'm sure 130 looks like a nice resistance level, 135 looks like a nice resistance level. Those are, big round numbers, psychological levels. But if you tried to sell those points, I mean, it didn't work. Instead, if you were looking for opportunities to join the trend, it would be much more fruitful. So then you ask me, how do I exit? What I usually do is I use a two-prong exit. I like to exit half of my position, basically, at a relatively conservative level, because I recognize that, currencies can be volatile, so I want to kind of take some money off the table when I have some profits. And then I will trail my stop on the rest of the position to try to capture and participate in as much of these moves as possible. So I like to bag a little bit of the winners quickly, and then use the second half of my position to basically participate and recognize the trending nature of the FX market.
Okay, good advice. Gosh, Kathy, we're getting down to our last 3 or 4 minutes here. I've got so much more I wanted to discuss with you. I guess I'm going to have to do a little triage on my notes. You describe yourself as someone who mixes technical analysis and fundamentals. Let's jump into how you do combine the two. But you had written one thing that I was really interested in hearing you develop a little bit. When you write about fundamentals, you had one particular point you made: identify which news releases matter. And you wrote, to forecast employment, look at employment component of PMI reports. Australia will release the Purchasing Managers Index for the service, manufacturing, and construction sectors prior to the official employment report. Within each of these reports is a subcomponent titled as employment. If the employment component of the 3 reports increased from the previous month, then there is a good chance that the number of jobs created increased as well. Okay, so we know that every economist on or off Wall Street is doing this already. Isn't the real determinant in market moves whether the consensus forecasts are beat or not? How can the individual investor hope to determine that if the economists can't even get their numbers correct?
I think that it's a misconception that everyone on Wall Street is looking at these things, because if that's the case, then the estimates wouldn't be so skewed. Economists on Wall Street have a much tougher job than I do. They have to figure out the exact amount of how much job growth or lack thereof there will be on a month-to-month basis. I just have to figure out the surprise and how I can trade on it. So from that perspective, they have to have a model that works month after month after month. And so sometimes it may not be accurate, whereas by predicting the surprise, it's an easier job. So it is quite reliable in the sense that a lot of the employment reports of these PMI and even ISM numbers can be leading indicators for any type of employment report. And those are tradable releases. I mean, I trade this all the time. I use a lot of these different indicators to gauge for me the surprise in economic data. I mean, for example, just overnight we had the Australian retail sales number released, and the number was disappointing. The market did expect a slight disappointment, but it was more disappointing than expected, and the PMI report gave us clues on that, because service sector PMI was also very weak, and retail sales is a big component of service sector activity. So it still means that these things are tradable. And the way that I incorporate this into my own analysis is that if I see a setup, and I have a bunch of strategies that I trade, and the setup signals and tells me to buy Aussies, for example, if there's a number that I think is going to be weak, I'm not going to buy Aussies. If there's a number that I think is going to be strong, then that gives me a stronger reason to get into the trade. So that's kind of how I combine both technical and fundamental analysis, which is I want my fundamentals to support my technicals, and vice versa, my technicals to support my fundamentals as well.
Mm-hmm. All right. Okay. Last question before we go. You mentioned Dodge Dorland. Are there any other names that you'd care to share that people that have been an influence on you, or perhaps there are books that you think would be good reading for all of us?
Well, I think that any type of market knowledge you can get is very useful, and I learned a lot from Dodge Dorland as well as other and former MTA members like John Tyrone and Steve Nissen. Those are good sort of basics for people to learn to get a good grounding on technical analysis. But I do think it's also important to learn a little bit about fundamental analysis, and that's what my books focus on, which is a little bit of fundamental analysis, a little bit of technical analysis, and recognizing the importance of both. So, of course, I encourage you to read my book, Day Trading, a Swing Trading Currency Market.
Of course. Of course. Well, Kathy Lien, it's been great having you with us today. Is there anything else you'd like to mention before we conclude?
Just the only thing I want to mention is that currencies are going to be part of our lives forever, and so I think that whether you're trading it now or you're considering it, definitely at least keep on top of currency movements. Over the next few years, you're going to see the market grow even further, and more different tools and instruments will be introduced to be able to trade currencies. So it may be a good time now to start looking into it and dabbling a little bit into it and seeing how the market works. And obviously, GFT is one of those providers that can help you get into the foreign exchange market.
Okay, all right, that's wonderful. Today's guest has been Kathy Lien, and that wraps up today's MTA podcast. From SeattleTechnicalAdvisors.com, I'm Ed Carlson, together with our recording engineer, Shane Squark in New York City. Say goodbye, Shane.
We'll see you next time, ladies and gentlemen.
All right, let's keep our stops tight. Good day.